Hi everyone, this is Mark with Ease Investing. In this video, we're going to go over the will strategy. We will discuss what the will strategy is and why the will strategy is important. Let's get into what the will strategy is. The will strategy deals with selling options. This is selling a put to get into the position and then selling a call once you are in a position. We'll go over this more later in the video. Why would you want to learn the will strategy? The will strategy is a valuable tool because by just knowing this one strategy, it allows you to add 3 streams of income in your life. So by knowing the will strategy, you will know how to make money in 3 different ways. Let's get into some examples. And by the end of this video, you will fully understand how the will strategy allows you to add income 3 different ways in your life. So let's get into the first step. The first step with the will strategy is selecting a stock that you want to own. In this example, we will do the stock SoFi. Keep in mind, when you are doing the will strategy, the more expensive the stock, the more money you will need to start the will strategy. The less expensive the stock, the less amount of money you'll need to do the will strategy. We could see that SoFi is trading for $26.74. So keep in mind with this example, this is for a stock that's trading around $26. After you have selected your stock, the next step is selling a put. Let me show you how you access selling a put in Robinhood. For this, after you have selected the stock, you will click Trade and then click Trade Options. When selling a put, you need an expiration date. Here we will do December 19th. Make sure that Sell and Put is selected at the top. We can see here on the screen, after we have selected our expiration date and after we have selected selling put, we can see that the share price is $26.74. If you don't know what selling a put is, the easiest way I can explain it is think of yourself as a promise maker. By making a promise, you get paid money for making the promise. So here, by selling the put, most of the time people will sell a put with a strike price. Here on the left hand side are the strike prices. They will sell the strike price less than what the actual share price is. So in this example, we'll do a strike price of $26. So by selling the put, you are making a promise that you will buy 100 shares of the stock if the share price is below $26 by December 19th. I'll say that one more time. When you are selling a put, you are agreeing to buy 100 shares of the stock if the share price is below your strike price. By making that promise, you get paid money. In this case, you get paid $2.75. You'll times that number by 100, so you will make $275 by selling this put contract. Let's go ahead and click the $26 put. Click Sell. We'll do one contract, which is 100 shares. If we did $2.75 for the contract, since that represents 100 shares, that one contract, you will be getting paid $274.96. You would click Review, and then you would swipe up to submit. So that is the second step of the will strategy, is selling a put. Now what would happen is on December 19th, if SoFi was below $26, I would go ahead and buy 100 shares for $26 per share. And that would get us into the third step, which would be selling a call. The other thing that could happen would be SoFi would be above the $26 on December 19th. If that were the case, you would not move into step 3. Instead, this would expire and you would simply keep the $274.96. And then you could sell another put and see if the stock price is below your strike price. If it is below your strike price, then remember you'd buy 100 shares of the stock. And if it wasn't, you would just keep receiving your estimated credit. So let's say that SoFi is below $26. Let's say it's trading at $25 on December 19th. What would happen is I would still keep the $274.96, but now I would have to buy the stock for $26 a share, and since I did one contract, I'd have to buy 100 shares of that, which would cost me $2,600 to buy the 100 shares. Remember that I am paying $26 a share, and I received the $2.75 by doing this contract. So my break-even price would be $24, pretty much on the dot, since the stock's trading at $26.74, and I got paid the $2.75. That would take my price, my break-even price, down to $24. Keep that $24 in mind. So remember, I now own 100 shares of SoFi for $26, but I received that credit. So realistically, I own 100 shares of SoFi for $24. That $24 is important, and let me show you why. Now that I own the 100 shares, I can now move to step 3, which is the last part of the will strategy, and that involves selling a call. If you don't know what selling a call is, remember, you are getting paid because you are a promise maker. What you are promising is that you will now, instead of buying the shares when you're selling the put, since you're selling a call, you are now promising that you will sell your shares if those shares are above your selected strike price. Remember, here on the left are the strike prices. So remember, we said SoFi was trading at $25 on December 19th. My break-even price is $24. So I would want to sell a call that's above $24, so I'm making money. So let's say on this example, we're gonna move the call that we're selling. We'll select our expiration date for January 16th, 2026. We'll make sure sell and call are selected. And since our break-even price is $24, we're going to want to have a strike price above that. So let's do a strike price for $25. What we're going to be getting paid by selling a call is going to be less than this $4.60, since the date would technically be already December 19th, and that leaves you less time from December 19th to January 16th. But I'm just showing you the will strategy and how it works. So your first stream of income was the money you got paid by selling a put. Now this is your second stream of income, which is by selling a call. Remember, by selling a call, I am saying for this $25 call that I will now sell my 100 shares of SoFi on January 16th, 2026, if the share price is above $25 on that date. By doing so with this contract, I'm getting paid $4.60 per contract. If I times that number by 100, that'd be $460. So let's click on that, click sell, and I would do one contract, do $4.60, which is pretty much $460. Remember, my break-even price on SoFi was $24. So let's say January 16th comes by and SoFi is trading above that $25. My second stream of income is going to be because my break-even price was $24, and now I'm selling the shares for $25, so I'd make $1 per share doing that. Plus, on top of that, I would keep the money that they're paying me for selling this call, and that would be my third stream of income. which in this case is $459. So that is the will strategy, is you're selling a put, you're promising to buy 100 shares of the stock if the stock is below your strike price, and you get paid money for making that promise. That's your first stream of income. And then if it is below your strike price and you have to buy 100 shares, you can now move to your second stream of income, which is selling a call on those 100 shares. By selling the call, you're making a promise to sell your 100 shares if it's above your strike price, and you get paid money for doing that. So that's your second stream of income, is the money you make by making that promise. And your third stream of income is the stock appreciation. So in this case, it going from your break-even price at $24, if you had to sell these shares for $25, you make $1 spread. You go from $24 to $25, and that would be your third stream of income. In this video, we have discussed the will strategy, how the will strategy involves first, selecting a stock that you want to own, second, selling a put on that stock, third, if you are assigned 100 shares, selling a call on that stock, and you get paid by the money you make by making the promise, plus the money you get from the stock appreciation. This is the will strategy. Please like and subscribe.